So recently, just like yesterday being the 24th, the 25th, the whole market system was closed, like because of the Christmas, and all currencies, let me not say all, let me say a few currencies went on, like their banks were on holiday, so the whole market was not like going well at all. It was not, in fact, literally it was not moving. So I just took out today to just try and make some back tests, and I was looking at something in Fibonacci, like Fibonacci retracement. I was like, what is this tool for? So I was like trying to see something from the move to know if there's any like potential stuff and all those stuff. So I will take you to the charts and explain a little bit of what I just understood. I don't know maybe if I'm going through the right direction of how Fibonacci is, but they say anyhow you see the market, reflect to it how you see the market. So I'll take you to the chart and I will explain what I am trying to understand with the Fibonacci. So now we are on the charts, and based on the few things I've understand with the Fibonacci, I just started working on it like today, and I've understood that this is according to what I know, like what I have just done. So before you check the Fibonacci, you need to know what is the trend, because you need to follow the trend of the market. So if the trend is giving an uptrend move, this is what I look at for. So when the Fibonacci is giving, like it gives its impulsive move, you look for in the lower time frame for it to give like a lower time frame shift, a lower time frame shift. Then when it gives the lower time frame shift, then you take your Fibonacci, taking from the top to the bottom, with not the wick, just the bottom, not the wick. Then you mark out your 0.6 to 0.5. Then you mark it out just like this, and then you expect the market to fall down back to it, and you get a move. And you could also be waiting your stop below any liquidity, and you can target 1 to 4 risk ratio. So but most times there's, like, there's, for everything there's most times a little adjustment, because there are most times that the market comes like this. It comes in, it breaks first, like it might actually not tap on it yet, it might go like this, it might not tap on it, then it creates a new high. This gives your confirmation very well. Then when it creates a new high, it come back to tap on it and go. It just needs to tally so good with your demand and also your what they call it, your directional movement. So if you're trying to do it and you can fix it with your demand and supply Fibonacci, your demand and supply plus Fibonacci and your market structure, because you always need to relate it to the market structure, or you can relate it with your market structure with the Fibonacci and yeah, support and resistance. So let me just take you to the real market and let's just try it out. Let's just try it out here. So let's try it out. See, so normally the market was downtrending here, leaving us here with the last block zone out. And if we look at it, normally we always seek to say, okay, the market has given us a new highs. This is how I do it before, and I will explain this my normal strategy, because this strategy got me a whole lot. But it's not every single time. Every single strategy does not hit every single time. That's why you try and see what actually happened. So normally I do, this is the last demand zone that gave the high impulse, and the market never came back to it. So why the market never came back to it? I tried to do using the Fibonacci to know what was happening. So Fibonacci from here, come down here, here, and if you see, it was not at the liquidity. So this is 60, and if you look here, here is the shift. This is lower time frame shift that gave us our confirmation for the shift to the downside, giving us what I said in the other side. Then we wait. Then if you look at it, here is our 60 and 60, that is 60 point, that is 0.6. So that is literally here. So if you pay attention to it, this is really something. Yeah, I said not, that's here, that's here. I want to get it right, so that is just it here. You're taking your take profits, you put it below, that's it, and you take your risk ratio to 4. Let's see. So if you see, the market came down, left here as a liquidity because of our Fibonacci zone, then came, cleared that liquidity out and tapped in. See, snipes 1:4. Let's see if it went all the way. 1:4. You remember, this is on a daily because we know the trend is an uptrend. So 1:4. Oh, this is a whole very long trade. So it's just like saying the market is still going on. So this is just what I saw. So, but I'm still working on it. I'm still working on it to look for flaws and all those stuff. But we're still relating on it. So on this, I still base on lower time frame and all those moves. That's how I got this. Here, the same thing. This was a break down, and we got a shift here telling us the market has changed its direction to the downside. So when it is downside, this is the highs, this is our low, this is it. You see, this is just literally it here. The same thing for the downside, and the what, the market went break. There's that thing I was saying, creates a new highs, then come back, tapped on it, 1:4. That is just it. The same thing that happened here, it went like that. But I'm still working on it, still working on it. As soon as I get understand the whole stuff about the whole thing, I will still come back and address the whole thing. Thank you.